So finally, the last day of 2023 and a new year starts in the next year. That means another almost a couple of hours later. So I hope you're all doing well, and I hope you made your revisions of what we discussed yesterday on Index 110. To remind you, I had given you basically a couple of clarifications, a total of 3 clarifications on Index 110, giving you the contradiction which could arise under the Companies Act and Ind AS as far as control or a joint control or a significant influence is concerned. And if there is a contradiction, we need to apply the definitions and the other parameters as per Ind AS. Then I give you another input that when you are having a control over an entity, you need to consolidate that entity irrespective it is a company or it is an LLP or a partnership firm which is other than LLP. Then I give you a third clarification as well, that even if you acquire a subsidiary with a view to, make a subsequent sale, it would be classified as an NCA held for sale under Ind AS 105. But still a consolidation would take place, but the technique of consolidation is going to be slightly different as compared to the normal procedure of consolidation. Then we went ahead and we discussed the exceptions and the exemptions under Ind AS 110. And I also told you that when you say it's an exception, it is basically giving an option, a choice to the entity to consolidate or not to consolidate. And then we said exemptions would mean it is a mandate. You're telling the entity you cannot consolidate. So we took one set of exceptions, and that was the para number 4, clause A, which had got a total of 4 conditions. And this was typically applicable with 3 focus points. Number 1, it is supposed to be a chain holding. It is a case where there is an option and the exception becomes available to the middle company in the chain. The 4 conditions quickly to look at was, number 1, the middle company is supposed to be wholly owned by the top company. And if it is partly owned, you need an NOC from the NCI. The focus points that we are looking at is it is a wholly owned subsidiary of an entity, not an individual. And if there is a direct indirect percentage held in the middle company, then NOC may not be required. Second is the middle company is not listed. Third is it is neither in the process of getting listed. And number 4, the ultimate parent or the intermediate parent is making a consolidated financial statements, number 1, as per Ind AS, and number 2, it is meant for public use. So that was a set of exceptions where the entity, the middle company in a chain holding, could get a choice of consolidating or not consolidating. Then we went to a case of exemption, that was para number 4B. And in terms of para number 4B, the capital B, we decided a case of an investment entity. Recall, an investment entity typically would be an entity which is receiving a money from a couple of unrelated investors, and they make investments in other companies and they could get a control. And we made a 3-step model in terms of para number 4B. Once you meet the 3 steps, you accordingly decide consolidation is mandatory or it is mandatory, not required. The focus point is in terms of para number 4B, it could apply irrespective it is a chain or a non-chain holding. It is something which is mandatory, and the focus is investment entity. The parent needs to be an investment entity to kick off the 3-step model. The moment you say the parent is an investment entity, you go to the step number 2 and you look at the subsidiary is an investment entity. If yes, you get an exemption. If no, you go to the step number 3 and see, is the activities of the subsidiary similar to the parent? If yes, consolidation becomes mandatory. And if no, then consolidation is not done. So that was a quick recap in terms of the exceptions and the exemptions. I hope you've also made your revisions as well. And I think now it's time, first of all, to do a comprehensive question with you. And this is one of the questions which is given in the education material. And I am also carrying that question with me. So let's have a look at this particular question. And I'm going to take your inputs in terms of answering this question. Okay, let me zoom it a bit further. So I think this is good to go. We can clearly have a look at this question. Okay. Now, I'm going to read the facts of the question and you're going to decide the status in terms of the top company as well as the middle company, and we know which paras to be triggered in terms of the evaluation. So I hope you're ready to give the answers on this. Okay, good morning once again and Happy New Year in advance. In end, I might forget to wish. Thank you, Shruti. Thank you, all of you. Shankar sir, good morning. It's happy to end this year with a happy note. And your class, sir, we are glad, sir. Thank you so much. It means a lot to me. Thank you so much for the good wishes. And of course, I'll remember to, give you the good wishes at the end as well. Okay, so let's begin the journey. My focus now is on question number 8, and let's first evaluate the inputs. It says the following is the structure of a group which is headed by PQR, and we can clearly see that it is a non-investment entity. Now, before we read further, I think let me first of all make my evaluations. You can also start giving your inputs as well. Well, first of all, if it is a top company in the chain, would a para number 4A apply or not? I think let's put that question to you. If it is a top company on the chain holding, do you think this company could avail the exception which is available under para number 4A? I think let's get your inputs. And also, considering that it is a non-investment entity, would it be able to avail the concept of para number 4B as well? The triggering point in terms of para number 4B is that you need to be an investment entity. So I think we got the right answer on that. That's wonderful indeed. So para number 4A cannot trigger for PQR because it is on the top of the chain. Para number 4B cannot trigger because it is supposed to be a non-investment entity. And if it is a non-investment entity, your three-step model would immediately fail. Wonderful. Let's go to the next one. Now we can see in the middle of the chain, there is a company which is an investment entity and it is a wholly owned subsidiary of, it says, ABC. Well, I guess it says a subsidiary of ABC, not ABC. It should be written as PQR. So it is a subsidiary of PQR because on the top of the chain is PQR. Okay, now this is a middle company in the chain. So the question arises, will it be able to avail the exceptions given under para number 4A? Yes. It is in a chain holding and it is middle company in the chain. If it is able to fulfill the 4 conditions, then the para number 4A could apply. And interestingly, this is an investment entity. So if it is an investment entity, would it also be able to avail the 3-step model in terms of para number 4B? Let's get your inputs on that. The 3-step model works on the first triggering point that the company needs to be an investment entity. And in this case, it is an investment entity. So I think you can directly, of course, answer yes. The company could get an exceptions under 4A, it could get an exemption under 4B. And what happens if it is able to get the exemptions and the exceptions? I also gave you that if you're able to fulfill both of them, then the para number 4B is going to override. The para number 4B is going to override the concept of para number 4A. And that's wonderful indeed. So I think we should be able to get the grip absolutely very clear in the mind that he can avail a para 4A on the 4 conditions. He could get para 4B on the basis of 3-step model. And if both are met, then 4B would override the provisions of 4A. Wonderful indeed. Now, this company XYZ is got wholly owned subsidiaries. One is a company A Limited, which is a non-investment entity, and it is a subsidiary of XYZ carrying on the services which relates to XYZ. Interesting. A non-investment entity which is carrying on something which is similar to XYZ. And then B Limited is also a non-investment entity, but it doesn't tell me that is there similar kind of services done or not. So in the absence, I am going to presume that of course it may not be doing similar services. Okay, so I think the facts are very clear. It says, in view of the above structure, whether PQR and XYZ are required. He's focusing on PQR and XYZ are required from the respective reporting standpoint to present consolidated financial. For the above purpose, assume that the other conditions mentioned under para number 4A, 1 to para number 4A3 related to such exceptions are satisfied. So he's very clearly telling me that the three conditions are getting met. The para number 4A, 1, 2, 3 is met. 1 tells me it is a wholly owned subsidiary. I can clearly see yes. Second, it is not listed. Third, it is not in the process of listing. He says, presume that those conditions are met. Okay. So I think now let's start a status in terms of things. PQR, we've already said, is not going to get any kind of exemptions or any kind of exceptions. So can I say, in this particular case, he will be required to make a consolidated financial statements for sure. And interestingly, let me also clarify that once PQR is going to consolidate, he will consolidate all the subsidiaries. PQR would consolidate XYZ, he would consolidate A Limited as well as B Limited. He needs to consolidate the entire chain in this particular case. No exemptions, no exceptions, that is clear. Okay, now let's go further. Let's evaluate from the point of view of XYZ, first of all, the para number 4A conditions. And he's very clearly told us that three conditions are already met. He's very clearly said that the three conditions, assume they're met. It's given in the additional information. Other conditions in clause 1 to clause 3 are met. So the only condition which I need to evaluate in this case is that the ultimate parent or the intermediate parent is preparing a consolidated financials as per Ind AS for public use. Now, in this particular case, I am nowhere given that whether it's a listed company or not, but it says limited. So I think I've logically a presumption that yes, it is preparing console as per Ind AS and it is meant for public use. So we can safely assume that the fourth condition is also met. The fourth condition is also met. That can be safely assumed, which means he will be able to get the exception. Which means he will be able to get the exceptions under 4A. Great. Now, let's go further. Now, you need to be careful when you're looking at XYZ and evaluating the para number 4B. You need to be careful that this evaluation will be done for A separately and for B separately. You're going to run this three-step model for A separately and B separately and decide which subsidiary is to be consolidated and which one is going to be exempted. So let's begin the exercise for A Limited separately, and let's begin the exercise for B Limited separately, and let's make an evaluation. Now, my step number 1 is that is the parent company investment entity. So in the first step, I would say yes. Then I go to the second step and ask myself that is A Limited an investment entity? I said, no, it's not an investment entity. So we go to step 3. Look at the chronological order in terms of evaluation. Is the subsidiary an investment entity? No. So you go to the step number 3 and say, is the services provided by A relates to the services provided by XYZ? Yes, the services are related. The services in this case is related, which means in this particular case, consolidation would become mandatory. So in this particular case, A Limited will have to be consolidated. The consolidated financials of A needs to be done. XYZ would consolidate A Limited because in this case, the three-step model tells me that the services given by A is similar to the services given by XYZ. Now, let's go to B Limited. In this case, we say that is the parent company an investment entity? Yes. Then we go to the step number 2, is B an investment entity? No. So we go to the step number 3. I am nowhere given in the question that whether the services of B is relating to the services of XYZ. So I presume that the services are not related. And if the services are not related, then the consolidated financials of this company is not required. Okay, so we've, I think, got the inputs. That was right, Uday. So we've got the input that as per para number 4B, company XYZ has to consolidate A and it is not to consolidate B. So the conclusions of 4B will override the concept of 4A. So what is the moral of the story? We can say that as far as PQR is concerned, it has to consolidate all. As far as PQR is concerned, it is to consolidate all. PQR, as we said, will consolidate XYZ, A Limited and B Limited all. As far as XYZ is concerned, can I say it is going to consolidate only, it is going to consolidate only A Limited, it cannot consolidate B. Even if it says that I've got a choice of consolidating B, but para number 4B tells him that you cannot consolidate, so he will have to listen to the para number 4B. So in this particular case, XYZ will consolidate only A and B Limited cannot be consolidated in this particular case. I guess, friends, if you've been able to answer this particular question, your concepts are going brilliant indeed. Because I didn't get much answers on that. I was getting a few inputs, but I hope you've been able to get the answers on your own correct. Do give me inputs if you've been able to get the correct answer. So that was a wonderful question in terms of the para number 4A as well as para number 4B, giving us an insight in terms of how do we evaluate the 4 conditions and how do we evaluate the 3-step model, especially when the parent becomes an investment entity. Okay, so far, so good. Now let's take it further. The first phase of discussion is over. We've understood the concept of scope of the standard, understanding the cases of exceptions where you get an option, and understanding the case of exemptions where you're mandated that you cannot consolidate. Okay, now I am going to take it further and let's do the next level of discussions with you. Now, my next focus of discussion in the standard is going to be a control assessment. Before we come to the practical area of how the consolidation is done, our focus today is going to be how do we assess under Ind AS 110 that an investor is controlling an investee. As I've already said yesterday, that when you're looking at the concept of control assessment in Ind AS, it is a principle-based assessment. It is no longer a rule-based assessment where a percentage would be a deciding criteria. Now, what I'm about to do could be slightly technical because somewhere you could, consider a judgment as well. I know it's a very difficult task teaching people how to apply judgment and how to take decisions. But I think I am definitely accepting this challenge today. And trust me, T&C apply, the terms and conditions apply, but I'm going to give you a very good way on a step-by-step approach in terms of evaluating a control assessment. I'm sure you're going to enjoy the process of making a control assessment because we're going to take a variety of examples as well, understanding the aspect of control assessment. So let's begin the journey. Don't get worried on the notes because I'll be saying a couple of things, but I will do the documentation of the notes also very soon at a particular stage. So just relax and keep listening. Okay, so let's, I think, begin the journey. And I am first of all coming to the concept of a control assessment, and let's read what is given in para number 5 of the standard. Don't get worried on the notes will be coming later. We're just first going to appreciate some inputs. So let's read it with me. If I come to the para number 5, the para number 5 says an investor, regardless of the nature of its involvement with the investee, shall determine whether it is a parent by assessing whether it controls the investee. So he is very clear on one agenda. And I think if you remember, when I started the concept of Index 103, I very clearly told you that there is a sequence in terms of assessing the relationship. You need to first of all see that as an investor, do you control the investee? If not, is there a joint control? If not, is there a significant influence? If not, then are you a passive investor? So the standard very clearly gives you the focus that investor, regardless of the nature of involvement, he will first of all determine whether he is a parent, and you need to evaluate, do you control the investee? Then he adds on, an investor controls an investee when it is exposed or it has got rights to variable returns from its involvement with the investee and is got the ability to affect those returns through its power over the investee. Well, whether you understand the para number 6 or not, you would have understood one simple thing, and that is, in this particular paragraph, you can see the assessment of control is nowhere a percentage based. In the entire para number 6, he is not telling you that you would control an investee if you've got a certain percentage stake or voting power in the company. Nowhere it is stated that. Now, he's given an explanation to the para number 6 in terms of thus. An investor controls an investee if and only if the investor has got all the following, and you can see the 3 conditions which will give rise to a 3-step model. The standard itself is giving you a 3-point recognition criteria in terms of assessment of control. So if you meet all these 3 conditions, then we can say, yes, as an investor, you control the investee. Let's see what are the 3 parameters. It says investor controls the investee if the investor has got power over the investee. So the first step is to make an assessment. Does the investor have a power over the investee? Now don't get worried on what is power. Then he says the investor has got an exposure or rights to variable returns. The second focus is the investor is exposed, or he has got rights to variable return from his involvement with the investee. And then it says the condition number 3, the ability to use its power over the investee to affect the amount of the investor's return. So we can put it like this. Right now, I think let's first get the chain in terms of the 3 steps you need to apply. We will see what is to be evaluated within each step, but first let's get the chain very clear. When you are making an assessment of control, I would say we need to apply a simple 3-step model. I need to first of all apply a simple 3-step model. Hear the words very carefully. Step number 1. In terms of step number 1, you need to see, does the investor have a power over the investee? Now, how do you assess whether investor has got a power over the investee? That we're going to see later. Then we go to the step number 2 and we see, is the investor exposed to? Is the investor exposed to variable returns? I'm putting it as VR. Is the investor exposed, or he has got rights to variable returns? So is he exposed, or he's got rights to variable returns with the investee? And then you go to the step number 3, and we call this as linkage. You need to consider that there is a linkage between the power and the return. So there is a 3-step assessment to be done when you are making a control assessment. You need to investor, do you got power over the investee? 1. As an investor, are you exposed to variable returns from your involvement with the investee? 2. And then you need to see that the exposure and the power have got a linkage. That's what it says in step 3, ability to use the power, which you did in step 1, to affect the returns of the investor, So you need to consider the linkage between the step 1 and the step 2. Now, I know your mind is thinking, So how do we assess power? What do you mean by exposure to variable returns? How do you assess the linkage? This is what we're going to discuss one by one. Okay, but I guess the chain is clear. Now, what I'm going to do in this particular case, I am now just going to make a simple little chain of thought. So I'm first working on a 3-step model, and then we'll take it further. So if somebody were to tell me that I want to do a control assessment, I would say the control assessment is based on 3 elements, or we can say 3 steps. The keywords is, does the investor have a power over the investee? Does the investor is got exposure, or he's got rights to variable returns? He's got exposure, or he's got rights to variable returns from his involvement. And the step number 3, we need to consider the linkage in terms of power and variable return. Now let's do one thing. Let's focus on power. So I'm now going to take you to the next concept, and let's understand what is power. So let's now consider the part number 10, where we're given the inputs in terms of power. So now let's understand what is power. You need to evaluate things on a sequential step-by-step basis, and trust me, you will get a very good hang on assessment. Now it says an investor in terms of part number 10 is got power over the investee when the investor has got existing rights. That is 1. That gives it a current ability. That is 2. To direct the relevant activities. That is 3. So I would say, even in terms of power, there is going to be a 3 sub-steps I need to apply. When you're going to look at the concept of power, there are going to be 3 elements which you need to consider. Investor is got a power when he has existing rights, 1, A. That gives it a current ability, that is B, and to direct the relevant activities, that is activities that will significantly affect the investee's return. So if somebody were to tell me that how do you assess power, I would say, okay, does the investor have existing rights? Don't get worried on what is existing rights. We'll understand that. So we need to consider, does the investor got existing rights? Number 1. That gives him a current ability, that is 2, and this is to direct relevant activities. Existing rights, current ability, and to direct the relevant activities. So let me go back, and I think we can complete the chain in terms of the power. So when you're looking in terms of power, we've got a total of 3 sub-steps within this. The power would mean that you're going to consider step number 1A, step number 1B, and step number C. You need to consider that there are existing rights. You need to consider that there are existing rights. Now, what are existing rights? We'll see. You need to consider that it gives, these rights gives you a current ability. It gives you a current ability, and to do what? To direct relevant activities. To direct what I call relevant activities. So these are the key elements in terms of power. In order to assess the element of power, you need to consider existing rights, current ability to direct relevant activities. Sometimes I call this as ER, I call it as CA, and I call it as RA. So I call it as existing rights as ER, and I say current ability is CA, and relevant activities are A. So power is the element of ER, CA, and RA. Right? I guess, friends, you've got the chain of thought. It is important that you first get a chain of thought. So control assessment is going to be a sequential assessment in terms of step number 1, ABC, step number 2, and step number 3. What are the questions I need to evaluate? That thought should be clear. How do we evaluate the concept of power, the concept of existing rights or current ability or direction of relevant activity? That, of course, we'll see in detail. But I hope the chain is clear. Right, friends? I guess the chain is pretty much clear. Yes, my concept is clear. Wonderful indeed. Okay, so now let's take it further. Now, what I'm going to do with you, I will pick up each and every term one by one, and we'll first understand power. I'm going to first of all explain you the concept of power. We'll understand those three terms. Then after power is done, I'll come to the step number 2, and then we'll come to the step number 3. We'll do some questions in between as well to get a complete idea on control assessment. So let me, I think, first begin the journey in terms of the third term. So I'm going to first of all explain you the concept of what is relevant activities. So the first term which I'm going to explain to you is the concept of what is relevant activities. Now, he's already said very clearly one thing in the standard. Relevant activities are, you can say, those activities. Relevant activities are those activities which significantly affect. It says very clearly that they are those activities which significantly affect investees' return. It significantly affect the investees' return. So I still need to understand that what are the activities which could significantly impact the investees' return. The standard in Appendix B has given us examples of relevant activities. So what I'm going to do, I'm going to take you to examples of activities which could significantly affect the investee's return. So which means, as an investor, I should be in a position to direct these activities. I should be in a position to take decisions on these activities, because if I'm able to take decisions on those activities which will significantly affect the returns of the investee, I have power. Get my point very clear, that in order to take a control over an entity, I should identify, boss, these are activities which are significant to you, and I'm going to take your decisions. It is like, we can say, I can take decisions of, my son taking up his career. That is something very important for him. His career decisions, his marriage decisions. If I am, in a position to take all those decisions, then what do? I control my son. Bad example, but a good one to understand. I don't do that. I don't do that. Don't take me otherwise. Okay, so I think let's first go to the concept of relevant activities. Now, as I said, if you look at the appendix of the standard, Appendix B in terms of para number B11 has given us a list of all activities which are relevant in nature. You don't need to remember the list, but I think you should have a fair idea on what are the examples of relevant activities. So let's have a look at what are relevant activities. It says for many investees, a range of operating and financing activities significantly affect their returns. Examples of activity that, depending upon the circumstances, can be relevant activities includes, but they are not limited to. The standard makes it very clear that this list which we are referring to is an illustrative list. It is not an exhaustive list of the activities. It very clearly says that these can be relevant activities and they include, but they are not limited to. So this is purely illustrative in nature. This is purely, we can say, illustrative in nature. It is not something which is exhaustive in nature. So can there be any other activities which could be relevant in nature? Yes. Since the standard gives you a disclaimer that these are activities which are not limited to, it is purely illustrative examples. Now let's have a look at the example. Selling and purchasing of goods or service. If you're going to take a decisions, what you're going to sell, what price you're going to sell, from where you're going to procure, at what prices you're going to procure, I think I am taking relevant activities. Managing the financial assets during their life. You're going to see later in Ind AS 109 and Ind AS 32 that the financial assets of the company is managed according to the business model of the company. Like, for example, a company would make investments and those investments are to be kept till maturity, or those investments are going to be simply held for trading. Now, this is something which is a conscious decision of the management. If as an investor, I would decide a business model in terms of managing the financial assets of the company, I decide the business model, it's a relevant activity. Then he says selecting, acquiring, or disposing of the assets, researching and developing new products or processes, and determining a funding structure or obtaining funds. I think all these activities are pretty much, logical indeed. You got to take decisions on selecting, acquiring, and selling assets. You got to take decisions on the sale and purchase of the goods and service. You got to take decisions on obtaining the fundings of the company. So all these activities are something which is, you can say, relevant. These activities can significantly affect the returns of the investee. So if I am in a position as an investor to take decisions on these activity, I can definitely affect the returns in a significant way for the investee. Pretty understandable. So I think since the list is already there, so what I'm going to do, I am simply going to make a reference. So I can say these relevant activities, we can say few examples. So we can make a mention that few examples are given. Few examples are given in the Appendix 2 Ind AS. Few examples are given in the Appendix 2 Ind AS 110. So for your reference, these examples are given in the para number B11, which is already there with you. So it is given in the para number B11 of Appendix B. So you can refer the examples list which I've given you. So few examples are given. So why did I say that there are few examples? Because we clarified that these are purely, you can say, illustrative in nature. They are purely illustrative and not exhaustive. They are purely illustrative and not exhaustive in nature. So I think this part is clear. I think the first term I've elaborated very clear. So we should be in a position to understand that a power means as an investor, I can direct relevant activity. So those activities which can significantly affect the returns of the investee is something we can say relevant in nature. So if you are in a position to take decisions on these activities as an investor, we can say one of the parameters is met. I guess, friends, the first term is pretty clear. That is relevant activity. So this is like step number 1C. We're starting in a little reverse gear. We're looking at step number 1C. Okay, let me see if any questions coming so far, though I think this should be pretty simple. Okay, and Shruti, sir, the way you teach, you will be a great faculty for law subject as well, like focusing on every word. Okay, thank you so much indeed. Law was always a favorite subject, but I never took it up. Let me also share the inputs to you that I wanted to be a lawyer as well. I think that's a very good observation indeed. I even passed my entrance exams and I also enrolled for LLB, but never gave my exams. So that was a passion again. I want to become a lawyer as well, but I think the passions can be, taken up anytime as well. Okay, so this is done. Now let's go further. So we are back on the chain. Let me now come back on this. So I've given you the first input, that is direction or relevant activity. So what is a relevant activity? Now let's go to the next term, and that is current ability. Now don't worry, after we are done with these terms, we will do a consolidation of all the discussions also and create a mind mapping later, and you will be understanding it with a lot of examples as well. So now let's come to the second term, that is a current ability. So my focus now is on the next term, which is step number 1B. Which is step number 1B, and I'm looking at the word current ability. I'm looking at the word that is current ability. Now, caution friends at this stage when I use the word current ability. When I'm using the word current ability, what comes to the mind is current means as of now. Generally, when you hear this word current ability, what comes to the mind is as of now. But let me clarify that in the standard, when we use the word current means when the need arises. The word current means when the need arises. So when you're looking at that you've got certain rights, when you're looking at that as an investor, you've got certain rights, and these rights will give you a current ability. That means the right should give you an ability when the need arises. वक्त आने पे, यानी कि जब वक्त आएगा मैं डिसीजन ले पाऊंगा, then I've got a power. I have certain rights today. I have certain rights today. So let me give you the same example. Let's say parents would be able to take decisions regarding the careers of the children, regarding their marriage of the children. So when the need arises, they have rights, being parents, that they will be able to take decisions when the need arises on the relevant activity. The career decisions, the marriage decisions are relevant activities. So when the stage arises, when the need arises, the parents with their rights will be able to take decisions on the relevant activity. So when I use the word current ability, don't consider current means today. Current means when the need arises. You have certain rights today, which will be, putting you into a position to take decisions on relevant activity when the need arises. Now, I need to take a couple of examples understanding the concept of a current ability. But before that, I have a small question, friends, to you. Do you understand the concept of options clearly? A forward contract, can I safely assume that you all know what is a forward contract or what is an option contract, and the concept of what is in money, what is at money, what is deeply in money? Sir, are you teaching us financial reporting or you're talking of financial management? It seems at the end of the year, your focus is changing from financial reporting to financial management for a little. So are you aware of these concepts? Can I safely presume this? Are you aware, friends? Give me inputs. Are you conversant with the concept of what is a forward contract, or what is an option contract, what is in money, what is at money, what is out of money, what is deeply in money, what is deeply out of money? We just need a basic understanding of this. Can I safely presume that? Okay, I'm here to get some inputs on that. So in the meantime, I guess I'll presume that yes, you have the basic inputs. I guess some basic idea would of course be there. Okay, I guess Suraj tells me, no, sir, not yet. We're yet to start with AFM. Okay, so I think I need to give you a little idea. So let's do one thing. Let's give you some basic idea on the concept of a forward contract. And let's also give you a basic idea on the concept of an option contract. So I'll just give you a basic idea. This is only for the purpose of understanding this particular standard. I'm not teaching you in detail on these things. I'll just give you a basic idea, though I think few of you already know the concept as well. It's okay. So, okay, for those who don't know this, I think let's explain them to them. And I think those who know it would also now understand things. It'll just be a revision for all of you. Let's first understand a case of option contract with a very basic example. Let's say there is Mr. A and let's say there is Mr. B. So let's take a very basic example to understand this, that let's say there is Mr. A and let's say there is Mr. B. Now, Mr. A approaches Mr. B today. Mr. A approaches Mr. B today and tells him that I want to buy 1,000 shares. I want to buy 1,000 shares of company XYZ Limited from you at the rate of 20 rupees per share. Mr. A approaches Mr. B today and tells him that I want to contract with you, that I am going to buy a total of 1,000 shares of company XYZ at the rate of 20 rupees, but this will be done 3 months later. So he says, let us contract today, but I'm going to come to you at 3 months later. So the contract is entered today, but he says that I will give you the money 3 months later. You deliver the shares to me 3 months later. Now, in this particular case, now let me first of all tell you certain terminology. Let me now tell you certain terminology. Since Mr. A enters into the contract to buy, When you say you entered into a contract to buy, it is called a call option. It is called a call option. Now, why do we call it as an option? Because Mr. A will pay a option premium to Mr. B. Mr. A will give him some sort of a token money today and tell him that, okay, this is the option premium. Why it is an option premium? Because Mr. A tells Mr. B that after 3 months, whether I am still interested to buy the shares or not, I'm going to decide. He says, I will look at the market conditions at that time. If I still feel I'm interested to buy, I will buy it. If I'm not interested, I've got the right to refuse and tell you, boss, I'm not interested. And you will not be able to say anything to me because I'm giving you an option premium today. And this option premium will give me a choice of deciding, an option to decide whether I want to buy it or not. So Mr. A enters into a contract with Mr. B, pays him a token money, which is an option premium today, and tells him that if I am interested after 3 months, I will buy. If not interested, I will not buy. But this premium is yours. At the same time, he says this premium is completely yours. Even if I buy, this premium belongs to you. Even if I don't buy, the premium belongs to you. This is a money which is being given, which gives me a right to refuse. And you're going to get this money irrespective of whatever decisions I take at the end of 3 months. Now, further, let's give you a terminology. For Mr. A, this option will be called as that he's taken a long position. So for Mr. A, this will be called that he's taken a long position. When we say it's a long position, it is like getting a contractual right. It is like taking a contractual right. I think it's good that I'm explaining you these things because I'll need that in financial instruments as well. So in this particular case, Mr. A is taking a long position and Mr. B in this case is taking what we call a short position. So a person who is going to get a right takes a long position and the person who is under obligation takes a short position. Since Mr. A is getting a right, he is under a long position and Mr. B is getting an obligation towards A, he's taking a short position. The one confusion which many people do get, and I think I want to clarify that as well. If I say what is the position of Mr. A, I would say it's a long call. And if you say what is the position of Mr. B, I would say it's a short call. Many people have got a misconception that a call for one is a put for another. No. So we can say that for Mr. A, it is a long call and Mr. B, it is a short call. A call is a call for both the parties, a buyer and a seller both. So it's a call for A, it's a call for B, but how do you distinguish? We'll say it's a long call for A. The person who pays the premium gets a long position, a right. The person who receives the premium gets a short position because he's under obligation. So I hope the terminology is clear. So Mr. A approaches Mr. B today and gives him an option premium, which gives a right to Mr. A to refuse or to exercise. And Mr. B gets the premium irrespective of whatever Mr. B A does. So in this particular case, Mr. A is called a long call position and Mr. B is called a short call position. Now let's imagine what happens later. So let's imagine what happens later. Now let's consider at a later stage. Let's consider now at a later stage, which is 3 months later. Let us see what happens after this contract is entered into today and we're considering the position 3 months later. Now let us say the market price of these shares in the market is, let us say, at the rate of 25. The market share is at the rate of 25. Now Mr. A starts making an evaluation. He says that I've entered a contract with Mr. B that I will buy the shares at 20, whereas the same share in the market is available at 25. So he is very keenly interested in buying the share because he's entered into the contract to buy it at a cheaper price. So if the prices are increasing in the market, he's very keenly interested that yes, I will buy the shares. So if the market price is 25, that means the prices are increasing. We can say in this case, Mr. A is definitely interested. He's definitely interested to buy because his contract allows him, gives him a right to buy it at 20. So what he can do, he can buy the shares from B at 20 and then later sell it in the market at 25 and still pocket a difference of 5 rupees per share. So he is very much interested. The moment the prices are increasing, he will say, yes, I want to exercise the right. And then B will have to give him those 1,000 shares, deliver him those shares. But let's say the market price of the share drops down and let's say it comes to at the rate of 14 rupees per share, it is decreasing. Now, Mr. A would think that if the same share is available in the market at the rate of 14, why would I interested to buy? Why would I buy it at the rate of 20 from Mr. B? I can buy the share in the market, open market at 14. So now Mr. A is not interested in buying. So he will refuse Mr. B that I am not interested to buy this share. He will tell him, boss, I'm not interested because the prices have gone down. I'm sorry, I don't want to exercise this option. And let's consider the market price of the share is, let's say, to the extent of, let's say, 20 rupees itself. It is constant. There has been no change in terms of the price. It is constant at the rate of 20. Now, this will give Mr. A an indifference position. He would say that, whether I buy it from B or I buy it in the open market, the status is the same. Because I'll land up paying 20 rupees in the open market, or I will land up paying 20 to Mr. B. So he's got an indifference in this case. He's indifferent to the entire situation. So you can see that how would Mr. A act upon in the future is completely dependent upon, what is the price movement in the market. If the price is going to be, you can say, bullish in nature, because when it is increasing, it is bullish in nature, Mr. A will become interested. When the price in the market is going to be bearish in nature, so when it is going to be bearish in nature, then in that particular case, Mr. A will become disinterested. And if it is going to be equal, then he's got an indifference point. Now, technically, let's give some terminologies to this. So when you say that Mr. A is interested, it is called the option is in money. So it is called the option is in money. And when you say that he would refuse, he is not willing to exercise, we say it is out of money. Then in this case, we use the technical term, it is called out of money. And in a situation where it becomes indifference to A, we say it is at money. So this is the technical terminology, what we use in financial management. So I guess you've understood the technical terminology, etc. I'll just make a quick run through of things. So you can say that Mr. A wants to get an option to buy the shares from B. He is deciding that I may or may not buy the shares from B at a future date. So he approaches Mr. B today, pays him a token money, which is technically called an option premium. This money gives A right to refuse and a right to accept. Mr. A, by paying a premium to Mr. B, gets an upper hand, and he is in a position after 3 months to tell Mr. B, yes, I'm interested. Mr. B says, okay, sir. And if Mr. A says, I don't want to buy, Mr. B says, okay, sir. So B is always under an obligation and A is always under a right. The person who pays a premium is called a long call position. And the person who receives the premium is taking a short call position. Why is it a call? Because it is a contract to buy. I'll be coming to another example also. So when it is an option to buy, it's long call and it is a short call for B. Now, the position whether A would exercise these options later or not all depends upon the movement of prices. If the option is a call option and the market is bullish, A is interested in money. When the prices are bearish and falls down, A is not interested, it is out of money. And when it is an indifference point, because when it's an indifference point, it is called at money. Let's also add a few more things. Let's imagine that the market price of the share turns out to be 80 rupees per share. Let's say the market price turns out to be 80 rupees per share. Now Mr. A is very, very much interested. because he can buy the share at 20 and then sell the share in the market at 80 and pocket a huge difference of 60. He's very much interested. So I would say he is keenly interested. In this case, he is keenly interested. And when he is too much keenly interested, in this particular case, we say it is deeply in money. Then we say it is deeply in money because he is very highly interested in the deal. You're interested, it is in money. You're very much interested, it is deeply in money. And the same logic goes, let's say the market price drops to 2 rupees per share. The deal is at 20 and the market price drops to 2. Mr. A would say, no, I'm not at all interested. So he is absolutely disinterested. He's absolutely disinterested in the deal. And I think you would be guessing the name correct. If he's absolutely disinterested, we're going to call this as deeply out of money. We're going to call this as deeply out of money. So this is the situation which will become. So there are 5 kinds of positions, which could arise on Mr. A. The position is A is interested in money, highly interested, deeply in money. Not interested out of money, absolutely not interested deeply out of money, and he's got an indifference point, it is at money. I hope, friends, you've understood the entire terminology relating to the option contract. I guess you're pretty clear with the terms, right? I guess we're pretty clear with what is a call option, what is a long call, what is a short call, what are the terminologies of in, at, out, deeply in and deeply out, right? Okay, I hope so far so good. Now, let's give you another example, a reversal one. This was call options. Let's take another example to understand this. I think I've been teaching you a little financial management for a change, because only we need this information not only in this standard, but also a lot in terms of financial instrument standards later. Now let's take another example, Mr. A, and let's take Mr. B. So let's give you complete knowledge. Incomplete knowledge is never good. So since we've talked of a call option, let's also talk in terms of a put option to get it clear. Now, Mr. A approaches Mr. B today. Mr. A approaches Mr. B today and tells him that I want to sell 1,000 shares. I want to sell 1,000 shares of XYZ Limited at the rate of 20 rupees per share. But he says this is going to be done 3 months later. So he enters into the contract with Mr. B and tells him that I will come and sell you these shares later. Now mind it carefully. Mr. A pays a premium to Mr. B. Mr. A pays a premium to Mr. B. If he pays a premium, then in this case, he gets a long position. Whosoever pays the premium takes a long position and it gives him a right to refuse. And Mr. B in this particular case is getting a premium, so he gets a short position just like the previous one. He gets a short position and this will put him under an obligation. Your position is to be decided from the point of view of the person who pays a premium. Who pays the premium takes a long position, who gets the premium takes a short position. Now, since it's an option to sell, it is called a put option. An option to buy is supposed to be a call, an option to sell is supposed to be a put. So in this case, I would say Mr. A is taken a long put and Mr. B is taken a short put. Like in the previous case, it was long call and short call. Here again, the put remains a put for both. So we can say it is supposed to be a long put for A and it is supposed to be a short put for B. So we know that A gets a right to refuse and B is under an obligation to accept whatever Mr. A tells him. Now, let's do the same thing. In this particular case, let's do the evaluations and decide, let's say what happens 3 months later. Let's say what happens 3 months later. Let's understand quickly the terms related to the put option as well. Let's say the market price of the share, let's say increases at the rate of 25 per share. There is an increase in the price. Now, Mr. A may starts making an evaluation that I entered into the contract that I will sell the shares to B at 20. And if it is saleable in the market at 25, why would I sell it to B? I would prefer to sell it in the outside market. So in a put option, if the market is becoming bullish, I'm not interested. I'll rather prefer to sell it outside than I'm not interested. If I'm not interested, it is out of money. If I'm not interested, it is supposed to be out of money. Let's say if the market price drops down and the market price comes to 14 rupees per share, it becomes bearish in nature. It becomes bearish in nature. The market price is coming down. Now, Mr. A would say it is good to sell it to B at 20 because in the outside market, it is saleable only at 14. He's very much interested. So we can say in this case, he is interested. And if he's interested in this case, we can say it is supposed to be in money. Not interested, out of money. Interested is in money. Interested for in money. Not interested, opposite of in is out. And let's say the market price of the share is prevailing at the rate of 20, it is constant in the market, then you can see that I would be indifferent to the situation. Because whether I sell it to B or I sell it in the open market, I am indifferent. So this is going to be what we call at money. Same terms, that if you're interested, it is in. If you're not interested, it is out. And if it is indifference, it is at money. And if you're highly interested, deeply in money. Highly disinterested, deeply out of money. So in this particular case, let us say the prices increase to 80 rupees per share. I am absolutely not interested. It is going to be something we can say deeply out of money. If the market price, let's say, comes down to 2 rupees per share, I am very much interested. It is deeply in money. The same terms, everything is same. So moral of the story, in terms of the option contract, the moral of the story is that if you enter into a call option, you will exercise when the market is bullish. You will not exercise when the market is bearish. If you want to buy something from someone, you're interested when the market is bullish in nature. When you go to sell something, you will be interested when the market is bearish in nature. So when you enter into an option to buy, you are anticipating the market to become bullish, then you will exercise option. When you enter into the contract to sell, you are anticipating the market to be bearish in nature. And in this particular case, you would exercise when the market becomes bearish. So when you're interested, it is in. When you're not interested, out. When it is indifference, it is at. When it is highly interested, deeply in, and not interested is deeply out. And also remember, a call, a put, a put. A call is a call for both. A put is a put for both, except we take a long call, short call. A long put and a short put. That was in short the summary in terms of understanding an option contract. I hope, friends, I am pretty much clear on this. Understood? Wonderful indeed. Now let's also give you a little insight in terms of forward contract as well. When I look at a forward contract, it reminds me, one of the famous dialects. I am a little keenly interested in telling you, forward contract is like एक बार जो commitment कर दी, उसके बाद तो मैं अपने आप की नहीं सुन सकता. Sorry, but I think I wanted to say that to give you an explanation of what is a forward contract. So when you look at a forward contract, now let's see what is a forward contract. Unlike an option, you see, in terms of option, you get the right not to exercise. You have the option of deciding that I don't want to exercise. Now, if it is a forward contract, let us say Mr. A enters into a contract with Mr. B, that I say that I will buy, let's say, 1,000 shares. I will buy 1,000 shares of company XYZ Limited, let's say at the rate of 20 rupees per share. Same thing, let's say 3 months later. So in this particular case, Mr. A enters into a forward contract. Now, irrespective, whatever the market positions might be, Mr. A cannot back out. So in terms of a forward contract, it is like एक बार जो commitment दे दी तो आप अपने आप की नहीं सुन सकते. He has to honor. He has to exercise this contract irrespective of the market price. Irrespective of the market price post 3 months later. He cannot make any evaluations unlike an option contract that I will buy or I will not buy. Whatever is the position, if he's getting a gain, he has to excise. If he's going to suffer a loss because of excising, he has to excise. So a forward contract is that there is no, you can say, option to back out. Once you enter into a contract, you need to honor the contract irrespective. Right, friends? I think that is good enough to give you understanding of the concept. Now let's come back to India's 110. I was looking at the concept of explaining what is the concept of a current ability. So we want to understand now what is the concept of current ability. There are a couple of good examples which are given in the appendix to the standard, with the help of which we will understand it further. And I'm going to give you then a very interesting chart. But just keep in mind that the word current ability means when the need arises. When the need arises. So when the need arises, will you be in a position at that time to take decisions on the relevant activities of the investee or not? Okay, let's, I think now, take you to a few examples understanding the concept of a current ability. Look at this example carefully. We're going to take some variations of this example. This is an example which is given in the appendix to the standard. There's an example which is given in the appendix to the standard in Appendix B, and this will explain the concept of current ability very finely. So let me just read this example to you. It says the investee has an annual shareholder meeting at which decisions to direct relevant activities are made. The decisions on relevant activities are taken in the annual shareholder meeting. So let me tell you in advance. As an investor, I need to assess when the meeting is going to happen. Mind the words carefully. As an investor, I need to consider when the annual general meeting is going to take place. Will I be in a position to direct those relevant activity? Because in that meeting, decisions on relevant activities will be taken. So as an investor, would I be in a position to direct the relevant activities at that stage? That is called current ability. The next scheduled meeting is in 8 months' time. That means I am sitting today and evaluating that once the meeting takes place in the next 8 months, when the meeting takes place in 8 months, will I be in a position to exercise the control or not? So indirectly, are we saying that the control assessment is something which is futuristic in nature? Yes. The control is something which can keep fluctuating. Today I control, tomorrow somebody else might control, because the decisions which I can take today, tomorrow somebody else would be able to take a decision. So control is something which needs a continuous assessment for a company. It is not a one-time assessment that once you decide that A controls B, I'm done. No, it is a continuous assessment. If there is a change in the facts and circumstances of the case, the control assessment is going to be a continuous assessment. It says, however, the shareholders individually or collectively holding at least 5% voting rights can call for a special meeting to change the existing policies over the relevant activities. But there is a requirement to give a notice to the other shareholder, means that such a meeting cannot be held at least 30 days. So generally, it says that when the decisions are taken, it is taken in the annual shareholders meeting, which is due for meeting in the next 8 months. But he said the decisions can be taken even otherwise. The shareholders can call for a special meeting, which you can give a notice, and it can be held in 30 days. That means effectively the decisions to direct relevant activities is going to be taken in the next 30 days. So I need to see, as an investor, will I be in a position to exercise the power in 30 days? Policies over relevant activities can be changed only in these special meetings or in the scheduled shareholders meeting. This includes the approval of material sales of assets, as well as making or disposing significant investments. So all relevant activities decisions are taken in these special meetings and in the shareholders meeting. Now remember, we are on the step number 1, power. Now we need to see what kind of rights does the investor have. I'm yet not given in the question what is the existing right. We will see what kind of existing rights can be there. So we will say, okay, we've got existing rights. I just need to see that those existing rights with me as an investor, will they give me the power to direct the relevant activities in the next 30 days? So that is the focus of the question, that once the meeting takes place in 30 days time, will I be in a position as an investor with my existing rights to direct those activities or not? So we're going to take some, examples. Each one is to be taken on a separate basis. So let's consider now situations. So we're going to consider a total of 4 situations, and then we'll summarize this all in the form of a chart. Okay, I hope this is visible. Good to go. No, I think we might have to zoom it a bit further. So then I'll have to take it down. Okay, so let me zoom it a bit further. Let's, I think, go to the example number 3A. So it is now sub-situations. The shareholder meeting, the special meeting is due in 30 days. I now need to look at the concept of power. So please watch this carefully. I am only on step number 1. I'm looking at power, in which I will look at the existing rights, the current ability, and the relevant activities. So one thing is pretty clear in this example, that we will be directing relevant activities. The meeting which is due in the next 30 days, you will be taking decisions on relevant activities for sure. I just need to see what kind of existing rights do you have, and do they give you a current ability or not. This part is already satisfied in the question. So my focus is only understanding what is the kind of rights the investor has got, and would it give him a current ability or not. Let's begin. An investor holds a majority voting rights. An investor is already got majority voting rights. So is that an existing right? Yes. So we can say in this case, he is got majority voting right. So this is an existing right. Well, let me tell you, simply you have got majority voting rights does not mean that you've got power. As of today, you've got majority voting rights. There could be certain reasons where this right might get snatched from you before 30 days time. So you cannot say that if you're a majority stakeholder, you cannot say that you've got control. No, because these majority rights are there with you as a part of the existing rights. But whether you will be able to exert that influence once the meeting takes place or not, that is important. It says the investor voting rights are substantive. Substantive means it is major, because investor is able to make decisions about the directions of relevant activity. The fact it takes 30 days before the investor can exercise does not stop the investor from having a current ability to direct. I think unless mentioned otherwise, if I am not given anything to the contrary, I've got reasons to believe that if you are a majority vote holder, I think it goes without saying that when the need arises, you will get a current ability as well. So can you give us an example that if I am a majority vote holder, but I may not have a current ability? Just imagine. Just imagine I am having majority shares in the company, and somebody else has entered into a forward contract with me where he's going to buy 50% of my shares. So I am also a party to a forward contract where somebody else has entered into a forward contract, which he will buy half of my shares before the meeting. In the next 15 days, the forward contract is going to expire. So the other party is definitely going to buy these 50% shares from me. So when the meeting takes place, I will no longer be a majority voting right. I have majority voting rights, but I would not be in a position to exercise and direct the relevant activities, because before the meeting takes place, half my voting rights will be gone. Did you get my point? Therefore, the word current ability is important. What you have today is not important. What is important for a control assessment is that what you have got today, would that be, in a position that you'll be able to direct relevant activities when the need arises or not? That is important. Okay, so this was the example number A. Let's go to example number B. Investor is a party to a forward contract to acquire majority shares in the investee. I don't have majority voting rights as of now. I don't have majority voting rights as of now, but I will be acquiring majority voting shares. So is this forward contract supposed to be in existing rights? Yes. So if you ask me that you are a party to a forward contract where you will be acquiring majority voting right, is that an existing rights? Yes. Can you now see the difference in terms of a rule-based assessment and a principle-based assessment? Here we are saying jiski lathi uski bhais. But here we are saying jiski lathi zaruri nahi uski bhais. So you are having majority voting rights today. It is okay. But whether you will be in a position to direct activities or not is a question mark. You are a party to the forward contract, which means the majority voting rights is there with somebody else right now. If I'm just a party to a forward contract, I don't have majority voting rights right now, but somebody else has got majority voting rights. So all I need to see that before the meeting takes place, will I be able to get these shares or not? Let's see. The forward contract settlement date is in 25 days. Wow. The meeting is scheduled in the next 30 days and your forward contract will settle before the meeting. So once the meeting takes place, will you be having majority voting rights at that stage? Yes, it'll definitely give you a current ability. So which means the moral of the story that in terms of a forward contract, what do you need to evaluate? In terms of the forward contract, you need to evaluate when the settlement of the contract will take place and when the meeting will take place. So can I say if the forward contract will settle before the meeting, you will say, yes, there is a current ability. But if you say that the settlement of the contract will take place, let's say after the meeting, then the current ability will not be there. Simple and logical. Because once the meeting takes place, will you be in a position to, get those majority rights? So if your forward contract will get settled before 30 days time, you will be in a current ability. But if your forward contract is going to settle after 30 days time, then once the meeting takes place, you will not have rights. Your existing rights will not give you a position to take decisions on the relevant activity. I hope you're getting the point. I hope I'm pretty much clear on the concept part. And no commission in a forward contract will, as far as the concept of, what kind of monies will be entered into, all that details you'll see in FM. I'm just giving you the overall picture. Okay, now let's go to the next one. So it says the existing shareholders are unable to change the existing policy. See what it says, the existing shareholder. Somebody is already got majority voting rights right now. They are the existing shareholders. They are unable to change the existing policies because a special meeting cannot be held at least 30 days, at which point the forward contract will have been settled. So we're just trying to explain that as a part of your existing rights, you do not have majority rights. Doesn't make a difference. What is important is that if you're a party to a contract where you will be able to get the majority voting rights, you'll get power at that stage. Okay, let's now take it further. Let's go to example number 3C and example number 3D as well. So let's have a look at example number 3C and D. So let me just slightly clear this up. So let's have a look at the example number 3C and example number 3D. It says investor is holding a substantive major option to acquire majority shares in the investee. This time it is not a forward contract, but it is option. So you are a party to a contract where you entered into an option contract, and it says to acquire, it is supposed to be what? It is a long call. Now, very simple. Please watch my analysis very carefully now at this stage, because after this, I'm going to make a chart on the current ability as well. So is the existing rights the option contract which you've entered into to acquire majority voting rights? Is that supposed to be an existing rights? Yes. So if somebody were to tell me that the option contract which you've entered into to acquire majority voting rights, is that an existing rights? Yes. Definitely you'll be directing relevant activity. Now we need to see that whether it gives you a current ability or not. Now watch me carefully. In terms of the option contract, we never evaluated whether you will exercise or not, because a forward contract is going to be exercised irrespective. But in terms of an option contract, you will definitely evaluate whether we will exercise or not. So in terms of option contract, two things are going to become relevant. Number one, whether you will exercise or not. And number two, is the settlement going to take place before 30 days or not? In case of a forward contract, you will definitely exercise irrespective it's good or bad for you. So we were not evaluating whether you will exercise or not. We were only looking at the settlement date. But in terms of option, you need to evaluate two factors. Number one, you will exercise or not. And number two, what is the settlement period? So there can be different kinds of situations. We can say, let us say it is in money, or let us say it is at money, or let us say it is out of money, or let us say it is deeply in money, or let us say it is deeply out of money. These are the 5 possible situations which can occur. Now, when you say it is in money, or it is out money, or it is at money, I'm taking all 3 together. When you say it is in money, it means, yes, I am interested, but it doesn't mean that it is a confirmed situation that I will definitely exercise. When you say it is at money, it's an indifference point. When you say out money, it means I am not interested to exercise, but doesn't mean that it's a confirmation that you will not exercise. So when it is going to be in money, at money, or out money, we can say it's going to be subjective. Because you cannot say with a confirmation that I will exercise or I will not exercise. So these cases will become subjective. You cannot take a direct call. But when you say that, yes, it is deeply in money, then the chances are that if it is, let's say, deeply in money today, and it is expected to be deeply in money when the period expires. Because when you entered into the contract, at that stage, it indicates, yes, the option is deeply in money, and you know that it's going to be deeply in money. The chances are highly likely that you will exercise these options. So in this particular case, I can definitely say, yes, I will exercise. And if it is deeply out of money, you can definitely say, no, I will not exercise. So it is only in a situation when it is deeply in money that you can say, yes, I will exercise. Then if you say it is deeply in money, I'll go back and decide the same factor. I will say, is the settlement going to take place within 30 days? Then yes, I get the current ability, otherwise not. So which means in terms of options, if you say the option is in, at, out money, I would say it is subjective. I can't tell you with surety that yes, I will exercise or I will not exercise. So it is subjective. So that cannot be asked in the exams, because subjectivity cannot be dealt. So in this particular case, it is subjective. It is deeply out, confirmed case, I will not exercise, current ability cannot arise. And if it is deeply in money, I'm saying, yes, I will exercise, but then you need to see that is the option going to settle before the meeting, then you get a current ability, otherwise not. So in this particular case, the option to acquire majority shares is exercisable in 25 days, 1, and is deeply in money, 2. The 2 parameters are met. It is deeply in money, 1, and it is going to be settled before 30 days, 25 days. Therefore, the current ability would arise. Trust me, the standard has not given us any examples when it is deeply out. or when it is in at out, because deeply out me as subjective, so no discussions. Okay, now let's take the example 3D. Investor is a party to a forward contract to acquire majority shares, and he says the settlement is going to be in 6 months' time. Well, I guess in this particular case, we've already seen if the settlement is going to take place in 6 months after the meeting, current ability is not present. So there are 4 examples which the standard is given at the end. One example is on a forward contract where the settlement is before 30 days. One example is on a forward contract where the settlement is beyond 30 days. And one example is given that you already have majority shares. And one example is given an option contract which is deeply in money and it is going to be exercised before the settlement date. Now my mind is working on a beautiful chart giving you all the permutation combinations in terms of 3 factors. You've got majority shares 1, you've got a forward contract 2 in which settlement before after, you've got an option contract which is in at out, deeply in out, and the settlement dates is before and after, so that the current ability becomes absolutely clear. I am teaching you how to take decisions which is based on judgmental factors. But what we're doing, where there is a judgment involved, we're eliminating that part because judgment cannot be evaluated in the examination environment. But at the same time, you're learning the art in terms of which combinations would give rise to judgment and which combinations will give you a conclusive decisions. Right, friends, I hope I am clearly clear on things. I hope everybody is able to understand so far. Just give me your inputs. I hope we are very pretty clear with the concept of the current ability so far. We'll be coming to existing rights after that, but I hope so far so good. Let's, I think, do some documentations with you. So I think let me just add a slide out here itself. So let's now make some notes on the step number 1B. We've seen relevant activities, the illustrative list given in para B11. And now we're looking at the word current ability. So this is step number 1B. So let's make an interesting chart in terms of current ability. So that we get the inputs in terms of various permutations, combinations as well. Once we are done with all these inputs, trust me, there is a comprehensive question once which came in the RTPs. And we're going to see that particular question because once your thought processes are clear, we can easily handle that question as well. Okay, I think we got the input clear. We just got 1 inputs. Okay, so I hope others are also pretty clear with that. I guess, your inputs gives me an insight in terms of, the futuristic things. Are we going in the right direction or not? So be a little more liberal in giving some answers as well. Okay, so let's begin with the current ability and let's make an interesting chart at this stage. So I'm going to give you some existing rights, different combinations of existing rights, and we're going to take the remarks in terms of whether a current ability arises or not. So let's take the situations, particulars. This particulars is going to give me examples of existing rights. So we are going to consider the existing rights and let's see whether the current ability is going to be present or not. So let's evaluate the current ability factors. So the focus is on the current ability. Okay, the permutation combination 1 is that investor has majority voting rights. Investor is got majority voting rights. Underline majority. I'm putting it as we are, you'll understand, is supposed to be majority voting rights in this case. Okay. So investor has got majority voting rights. I can say unless mentioned otherwise. I would say unless mentioned otherwise. So there is nothing which is given to the contrary unless mentioned otherwise. Current ability, I would say, is a yes. So as an investor, if you've got majority voting rights, unless there is anything to the contrary, yes, it implies a current ability. Okay, let's go to the next one. The second one is that investor is a party to a forward contract. Investor is a party to a forward contract, and let's underline forward contract. So investor is a party to a forward contract to acquire majority voting rights. Underline majority. So we are a party to a forward contract to acquire majority voting rights. So what we need to do in this particular case, we need to compare. We just need to compare two things. We can say settlement. The settlement of the forward contract is before meeting. The settlement of the contract is going to be before meeting, or the settlement is going to be after the meeting. So these are the only two combinations happening. So if you say the settlement is before the meeting, then we can say yes, the current ability will arise. And if it is after the meeting, the current ability would not arise. And that is the second one, the rights in the form of majority voting rights. Okay, let's, I think, continue this chart. And then let's take a third combination, which is on the options. So let's take a third combination. So this is the existing rights, and we're looking at the current abilities. So let's look at the combination number 3. Investor is a party. Investor is a party to an option contract. Underline the word option. So investor is a party to an option contract. Underline the word option. And this is to acquire majority voting shares, to acquire majority voting rights. So that was the third kind of example on majority voting rights. Now, everything depends upon, is it in money, is it out of money, or is it at money? Or depends upon it is deeply in money, or depends upon it is deeply out of money. So we've got a total of 3 permutation combinations coming in. It is in at out, it is deeply in, or it is deeply out. So I would say if it is in at out, it is subjective. We cannot give you any conclusion at this stage. It is completely subjective in nature. You need more facts and circumstances in order to decide, whether you're going to exercise or not. If it is deeply in, we can definitely say that we will exercise. And then you need to evaluate further. You need to see the comparison, again, make a comparison, compare. The settlement of this contract will take place before. The settlement of this contract will take place before the meeting, or the settlement is going to take place after the meeting. So everything depends upon the settlement. So there are 2 parameters. First, you decide you're going to exercise or not. Once you've taken a decision, yes, you will exercise. If your settlement is before the meeting, the current ability is a yes. And if it is after the meeting, the current ability is no. And then finally, if it is deeply out, we will say that we will not exercise. And in this particular case, if you say we will not exercise, there is no current ability. Okay, all the permutation combinations, I have documented them. My step number 1B is done. So if I come back to the concept of power where I started with, I gave you the step number 1C, relevant activity, done. Step number 1B, current ability, done. Now the focus is going to be on step number 1A, that is the concept in terms of existing rights. Right, friends, so far so good. I guess we are pretty much clear, crystal clear, I guess. I want you to give yourself now a comfort zone on a scale of 10 on your understanding so far on the control assessment. I know I'm not done. I've just given you the partial inputs in terms of step number 1, but your understanding on what is a relevant activity, typically I would say the current ability. So give yourself a comfort zone on a scale of 10. What is your comfort zone on the understanding of the concept of a current ability? Crystal clear, Mansha. That is wonderful indeed. Okay. So now let's start a discussion on the step number 1A. I'm just going to make some framework on the step number 1A to begin with. because there is a lot of deeper discussions which is required on step number 1A, because that is one of the crucial steps which will explain what kind of different rights can arise. And we'll be doing a couple of examples on that combinations as well. Okay, that's wonderful indeed. I think we got some scores 9, we got scores 7s and 8. I think anything which is 8 and above is pretty good indeed, because the technicality involved so far is not too technical indeed. So I think 8, 9 is pretty good indeed. Okay. Now let's go on to the step number 1A, where we need to understand the concept of existing rights. Okay, so for the understanding of existing rights, let's first give you a chain of thought. Let's first give you a chain of thought in terms of existing rights. Now, hear me carefully, friends. I'm going to first create a thought process in your minds. Understanding the concept of what is existing rights, let's create a thought process on step number 1A. You know, when you're looking at the concept of existing rights, now please look at this thought process very clear, because this is a crucial part which I'm giving you as a thought process. Then we're going to work upon this thought process with a couple of examples on this. Well, we can say the standard says there are basically two kinds of rights. The focus is there are basically two kinds of rights. Generally, we say one of the most common rights is voting rights. But there is another right which even the Companies Act also, endorses, and that is the right to appoint and remove the key management person of the company. So as an investor, I am in a position to decide who will be sitting as a part of the board of directors, the key management person of the company. So there are going to be two kinds of right. One is, you can say, the voting rights. So one of the rights is what we call a voting rights, and the other right is that you can appoint or remove. You can appoint or you can remove the key MP, the key management person of the company. Now, let me tell you one thing. The standard very clearly says that these are the two rights, which is either or it is and. Now, let me tell you one thing. As an investor, if I have got no voting rights, or maybe I've got very less voting rights, and I have the right to appoint and remove a KMP, theoretically, yes, you can prove a power. But in a practical life situation, it's going to be difficult just on the basis of the right to appoint and remove a KMP. You will not be in a position to prove a control. I read it somewhere and it said, that practically it is going to be a difficult situation. And I'll tell you why. At the end of the day, consolidation is going to be done on a mathematical front. Now, imagine that I've got a 10% stake in a company, or let's say I've got a 20% stake in the company, but I am in a power to appoint and remove the KMP. Now, if I say an assessment that yes, I control the investee and I do a consolidation, imagine consolidation is on a mathematical front. You've got a 10% stake in the company, so the 90% is with somebody else, which is called a non-controlling interest. Imagine how a balance sheet would look like if you're saying that I'm going to consolidate on the basis of 10% and you're going to represent 90% NCI in your balance sheet. So the experts feel that, simply saying that you control the composition of the board of directors is not enough to prove the concept of control. So even we're going to consider the same. So we're going to say that, if you've got voting rights and coupled with it, you've got right to appoint and remove, it's okay. But I'll not consider the word or. So I can say on a standalone basis, if you've got simply the right to appoint and remove the KMP, it cannot give you control. So you can say it is voting rights, maybe also appointment rights, or maybe not. But the focus is on the voting rights. Okay. Now, when you look at the concept of voting rights, there are two possible situations which can arise on account of voting rights. Let's say as an investor, I already have majority voting rights or I've got less than majority voting rights. So as an investor, we have majority voting rights. As an investor, we've got majority voting rights or we've got less than majority voting rights. Well, we've already said that unless there is anything to the contrary, if you've got majority voting rights, it implies that you've got power. So in terms of majority voting rights, there can be two situations. In terms of majority voting rights, there can be two situations that the power is there. You've got power. Or the situation is that in spite of the fact you've got majority voting rights, but there is no power. So there are three situations. You've got majority voting rights and you have power. You've got majority voting rights and you don't have a power. And you've got less than majority voting rights, but still you've got a power. So we're going to confront, three kind of situations. I have majority voting rights. Yes, I have a power. I have majority voting rights, but still I don't have power. Or I've got less than majority voting rights, but still I've got a power. Now, when you say that this is the case where you've got majority voting rights and you've got a power, this is unless mentioned otherwise. If there is nothing which is given to the contrary, unless mentioned otherwise, we will always presume that if you've got majority voting rights, it goes without saying that you've got power as well. Like I did the example earlier where I had majority voting rights as an investor, it goes without saying that yes, I get power as well. Okay, when you say that you've got majority voting rights and you've got no power, let me give you some examples which are given in the standard. And the standard says sometimes your majority voting rights are subject to approval. You need to take permissions from the court. You need to take permissions from the regulatory authorities before you could exercise your majority voting rights. So in this particular case, if your majority voting rights is subject to approval, you need to take approval from court. You need to take approval from the regulatory authorities before you can exert your voting rights. Then the power is not there. So this will be very explicitly given in a case study. So if you're given a situation where you've got majority voting rights and it is subject to approval, we will clearly assume that there is no power. The subjectivity actually arises in this particular case when you've got less than majority voting rights and we're trying to say that yes, you've got power. Now, how do you evaluate in this case that you've got power? Let me give you a further chain of thought. Now, the standard says in this particular case, that if you've got less than majority voting rights, how would you assess that there is still a power? Then there would be something else. That as an investor, more than, apart from the less than majority voting rights, there is a possibility that you might have also entered into a contractual arrangement. There is also a possibility that you might have entered into a contractual arrangement. Let me explain. It's like, I always tell people the term which we use sometimes called a coalition government, what you call a Gadbandhan Sarkar. So in this particular case, when you're saying a contractual arrangement, just imagine a situation. As an investor, I've got a 40% stake and I shake hands with another investor who's got a 20% stake and we contractually agree to act together. So I've got a 40% stake, the another investor has got a 20% stake, and in this particular case, since we've contractually agreed to act together, then we can have a power because we've got a contractual agreement with each other. The second possibility is that you've got less than majority voting rights, and along with that, you've got the right to appoint and remove the KMP as well. So we'll have to look at the facts and circumstances and decide that if you've got the right to appoint and remove KMP, apart from the voting rights, maybe you get a power. The third possibility is that you've got what we call potential voting rights, PVR. You've got potential voting rights. That means you have got something in the pipeline. You as an investor may be holding certain convertible instruments in the investee. You might be having certain convertible debentures or convertible preference shares, which are going to be converted into ordinary shares in the future. Like, for example, if you ask me, even the case of a forward contract and even the case of an option contract is similar to a potential voting rights. So today you've got less than majority voting rights, but since you've got more potential voting rights, you might get a power. Or maybe there is a situation that you've got nothing else. You've got nothing else, but this is what I call Andho mein Kana Raja. That I may not be having majority voting rights, but if you look at the question number 1, which we did yesterday, where I said that, there could be a contradiction in terms of a control assessment under law, Companies Act and the Indias, but I am a majority, I am a minority, in the sense less than majority, but I am practically a major. I am the only, major shareholder of the company with less than majority shares. Everybody relatively compared to me is small. And in those particular cases, even if there is no other arrangement, I can still get a power. And the 5th one, they say, is it can be a plus minus any permutation combination. Apart from less than majority, it could be a contractual arrangement plus a potential voting rights, a combinations of all these factors. I know now this is getting a little technical, but I just wanted to give you a thought process. So let me just take a thought process view. Then I think we'll give you a break and then we'll start working on these permutation combination. So when you're looking at the step number 1A, that is the concept of an existing rights. In terms of the existing rights, you can say voting rights are the major rights considered, but apart from that, you may also have the right to appoint, remove KMP. So the focus in terms of power is going to be based on voting rights. There are 3 situations. You've got majority voting rights, and it goes without saying that yes, you've got power. Number 2, you've got majority voting rights, but it is subject to approval, so you've got no power. And the 3rd one is the most interesting, that you've got less than majority voting rights, but there are different permutation combinations. You entered into a contractual arrangement with someone. You have the right to appoint, remove KMP. You have potential voting rights, or maybe you are relatively bigger as compared to any other investor. Or there could be a mix of permutation combinations, in which case you can get a power. Okay, I hope the chain thought of process is very clear, friends, at this stage. But I think it's time to give you a break as well. So I think it's almost around 8:47 by the watch. So I think around 10-12 minutes break, then I think we should start working on this. But I hope my thought processes are pretty much clear so far. So far, so good. Right, friends. So on that note, I think let's take a break and see you in another 10 to 12 minutes time. Enjoy a break. स्टार्ट कर देते हैं. Welcome back, friends. So I hope you had a mind relaxed. So I think now let's get on to a little more technical discussion. And to remind you, we are discussing the step number 1A. And power has got three elements. One is the concept of existing rights. The second is in terms of current ability. And the third is relevant activities. We've already discussed what is relevant activities example. We've seen the concept of current ability, and we're focusing now on the concept of existing rights. So I think let me first of all come to a little more detail on this particular combination, because we're going to do a couple of examples related to these permutation combinations as well. So let me, I think, take it further and give you a little more insight in terms of these permutation combinations before we go further. So I'm concentrating on the concept of less than majority voting rights. Investor is got less than majority voting rights, but we are making an assessment that yes, still it has got a power. Now, hear my thought process very carefully, because there are certain combinations which will definitely give us a conclusion that yes, there is a power, and certain combinations which would need evaluation of more facts and circumstance. Now, let's go to each of these combinations one by one. We'll take examples also, no worry. But I think let's first of all make a conceptual walkthrough on these 5 permutation combinations. We said as an investor, you've got less than majority voting rights, and you've also entered into a contractual arrangement as well. So the investor enters into a contractual arrangement with another investor as well. Now imagine, as an investor, I've got a 40% stake, and we enter into a contractual arrangement with another investor with a 20% stake. Now, my question is, would this mean that it is a confirmed case of power? I would say yes. If you've entered into a contractual arrangement with another investor, now you know that your share plus the other investor share put together gives you a majority. So I can say in this particular case, you will get a majority voting rights because of this. And if you're going to get a majority voting rights, it is definitely a confirmed case of power. It is definitely a confirmed case of power. I don't think so it needs any, ifs and buts in this case. So your share along with the other person's investor share put together makes it a majority. So unless there is anything to the contrary, it's a confirmed case of power. One. Next. Can I say along with less than majority voting rights, you've also got the right to appoint and remove the KMP. We've also got the right to appoint and remove the key management personnel of the company. Now, in this particular case, I cannot say that it is a confirmed case of power. If you got less than majority voting rights and you've also got the right to appoint and remove the KMP, we cannot say it's a confirmed case of power, but we can say yes, in this particular case, we need to evaluate looking at the facts and circumstance. So we're definitely going to look at an example on this. The examples which will give you a confirmed case of power, there is nothing to be evaluated. So we're not going to do examples on that. The standard in the appendix is not even given examples which a confirmed case of power. So we're going to see an example where coupled with less than majority, you've got the right to appoint and remove KMP. How do we evaluate? Next. Let us say you've got less than majority voting rights, and along with this, you've also got potential voting rights as well. As we've already said, a potential voting rights would mean that you've got, let's say, any convertible debentures or any convertible preferences held in the investee, which will convert your percentage into a majority. So is this also a confirmed case of power? I would say no. Because if you've got potential voting rights, the question rises whether you will exercise them or not. I've got convertible debentures or preference shares in a company. We need to evaluate whether the conversion is expected to take place. Is it going to be something which is deeply in money or not? And we also need to evaluate whether the conversion will take place before the date of the meeting as well. So even in this particular case, you'll have to do an evaluation as well. So we'll do a couple of examples based on that if you've got potential voting rights as well. Next, let us say you've got nothing else. There is nothing else apart from the less than majority voting rights. Now here again, it's not a confirmed case of power. It doesn't mean that if you've got less than majority voting rights, but you are, compared to the others, relatively bigger in size. It doesn't mean that it would mean that you've got power just because other investors are small in front of you. It is not a confirmed case of power. So I would say even in this particular case, you'll have to do the evaluations. So whether it's a case of coupled with the right to appoint or potential voting rights, or you've got nothing else, you cannot say it's a confirmed case. Evaluation needs to be done based on the facts. And if it is a combination of any of these, if it is a combination of any one of them, it's a combination of any one of them, that means it's a mixed blend of all these combinations. Well, I think if it is a mixed blend, then I think again, it's a case where you need to make an evaluations. You cannot directly say that it is a confirmed case. So I think out of all these 5 permutation combinations, this is the only case where you can say it's a confirmed case of power. In these cases, you'll have to read the facts and then take a call. And it's not going to be very difficult in terms of making an evaluation. So what I'm going to do now, I'm going to run through a lot of examples with you where we're going to see the assessment of power. Let me remind you, I'm still on step number 1. We'll be talking in terms of step number 2 very soon and step number 3, because that's not going to take time. Step 2 and 3 is going to be very simple, just a 1-minute discussion. So let's now go to the examples and understand how do we assess this. So I'm carrying a couple of examples with me, and I think let's start the journey. And we're going to look at these examples and see what kind of permutation combination is coming in. Okay, so let's have a look at the example number 4. I've taken this example from the appendix to the standard. You've got similar examples which are given in the study material as well. Once we're done with this entire thought process, you will be able to manage all the questions on the control assessment in the study mat. But let me also tell you one thing. There is another one area of control assessment, because we are right now looking at a control assessment when there is a power which stems out of voting rights. We also have another case of control assessment where you are supposed to be having a control because you are having the power to take decisions. So we can say the control assessment is of 2 types. One is which is based on voting rights, and one is which is based on decision-making rights, especially when you act as a fund manager to a particular fund. In those particular cases, the company entrusts you with a certain amount of fund which you are managing for the company. So the standard has given us insight in terms of doing a control assessment. In those cases, when you act as a fund manager, we need to see that as a fund manager, are you acting as a principal or are you acting as an agent? That's going to come later. So let's have a look at example 4. Investor acquires 48% of the voting rights. You've got less than majority. The remaining voting rights are held by thousands of shareholders, none of which individually has got more than 1% of the voting rights. He's given me the facts that you are having less than majority, but if you compare yourself to the others, your relative size as compared to the other investors is big. Then he says none of the shareholders has got any arrangements to consult any of the others or to take collective decisions. So there is no contractual arrangement of the other investors with other investors where they would act collectively. So in this particular case, this is the only inputs which is given. So the question arises, which case is this? It is a case of majority voting rights, and I am not given any information further. So as we said, it is something which you need to evaluate. Now, if you technically ask me in this particular case, looking at the facts of the case, if I only go with the fact that the relative size of this investor is much bigger as compared to the relative size of the other investors, we can say, yes, it indicates. It may indicate, I'm not saying confirmed, it may indicate that yes, the investor has got power. Mind the conclusion, I'm not saying it's a confirmed case. The investor concludes that it is sufficiently dominant voting interest to meet the power criteria without the need to consider any other evidence of power. I think since there is nothing given to the contrary, I think it's a very clear-cut case that if your relative size of holding is much bigger as compared to the relative size of the other shareholders, then I think you certainly get a power. So in this particular case, we can say the relative size. We can say the relative size of the given investor. The relative size of the given investor is bigger. Is you can say large. The relative size is large as compared to. It is bigger as compared to other investors. So we can say in this particular case, since nothing is given to the contrary, we can safely assume that if you compare your relative size, you got a 48%, everybody is too small in front of you, thousands of shareholders with 1% voting rights. I think comparatively, if you look at the relative size, one might conclude that yes, you've got a power. Okay, let's go to the example 5. It says investor A has got a 40% voting rights, less than majority, and there are 12 other investors holding 5% of the voting right. Interesting. This investor has got a 40% voting rights, and there are 5 other investors. There are 12 other investors with 5% each. There are 12 other investors with 5% each, and that makes it a total of 100%. At this stage, before I take it further, let me also tell you something more which is given in the standard. In this particular case, I have a 40% and there are 12 people. There are 12 other investors with a 5% stake. Now, if you say that 12 people put together with a 5% makes it 60, it seems that they could collectively act together and outvote me. Because I've got a 40% stake, and if those 12 people join hands together with a 5%, they become 60 collectively, and they could outvote me. But the standard has given us something very interesting inputs. The conclusion is more the number of people required to outvote the investor, you cannot snatch his power. It is very difficult for 12 people to join hands together. If there would have been 2 to 3 people, it is still easy that those 2-3 people will come together and try to outvote me. But expecting that 12 investors would be, joining hands together and they would try to outvote me as an investor is quite subjective indeed. So the standard also says more the people which are required to outvote you as a majority investor, your power will be there. So in this case, considering that 12 is supposed to be a larger number, it is difficult to prove that, these 12 investors will be able to snatch away the power from that 40% holder. So it becomes subjective for the time being. So we can say with this status, I would say if you give me this status, it is subjective. I cannot give a conclusive answer. It is subjective because we cannot say that 12 people might or might not be. Had there been lesser number of people, it is easy to prove that they will easily outvote you. But if there is 12 people, they joining together and creating a majority is a little subjective. Let's read further. It says a shareholders agreement grants investor the right to appoint, remove, and set the remuneration of management person. Now we can see this is a case where you've got, this was less than majority. So this is a case where you've got less than majority voting rights, and you've also got the power to appoint and remove the KMP. And this is again a case which needs an evaluation because you've got less than majority voting rights and you've also got the right to appoint, remove, and determine the remuneration of the KMP. Now see, watch the inputs. It says to change the agreement which gives you the right to appoint and remove KMP, to change the agreement, 2/3 majority vote of the shareholders is required. If you want to snatch away the right to appoint and remove the KMP, 2/3 people must agree, and then only this right can be snatched away. But do you think that 2/3 could be achieved? 2/3 would mean that you need a 66.67% people who can remove you from this right. I've got a 40% stake. I would never vote against myself. So those remaining 60% put together can also not take away this right from me. And I guess if you get the right to appoint and remove the KMP, which means you will decide who's going to sit on the seat and take a decision, then I think you definitely get a power. Because in this particular case, if you are the deciding factor, who's going to sit on the board of director, who's going to be sitting as a KMP and taking decisions, I will decide who will sit on the seat. I am the kingmaker. If I am the kingmaker, then I think it goes without saying that I would get a power. Just because the right to appoint and remove KMP cannot be snatched away from me. Because 2/3 majority is not achievable and this right cannot be snatched away from me. So we can say, yes, the power is going to be present in this case. So you can see in the first example, we're working on your relative size is larger as compared to the other investors, possibly the power can come. In the second example, they've tried to give the hint that you are a less than majority voting right holder and you've also got right to appoint and remove PMP, which is a very certain right. A definite right which nobody can snatch away from you. If that nobody can snatch away from you, the power comes. But if this particular right would have been snatched away, then it again becomes subjective in nature. Right? I guess we are clear with the two examples. Let's have a look at more examples with you. So let me come to example number 6. So these are all examples which are given in the appendix to the standard. I'm just making a walkthrough so that we get a clear-cut insight in terms of how decisions are done. Let's look at example 6. It says A is got a 45% voting rights, which is again less than majority voting rights. Then he says 2 other investors, each holding 26% of the voting rights. Aha. Now we can see that there are 2 investors with a 26% right, as I said a little while back. In the previous example, there were 12 investors and the 12 investors joined together and try to outvote me is a difficult possibility. But 2 people, will easily try to outvote me. If they join hands together with a 26% each, they get a 52% majority. I think it's a clear-cut case that I cannot have power. Because it is easy to prove that the 2 investors will immediately, join hands and try to outvote me. It says the remaining voting rights are held by 3 other shareholders. Each has got 1% each. So what is the status? I've got 45% as an investor. There are 2 investors with 26% each. And then the remaining is held by 3 people, that is 1% each, and that makes it a total of 100% stake. Now, in this particular case, we can see that only 2 people can easily outvote me. If the 2 people can easily outvote me, then in that particular case, I think I cannot have power. So I would say this is a case where we've got less than majority voting rights. And there is nothing else which is given. There is nothing else which is given. I don't have anything except this particular fact. So we can say in this particular case, only two investors are required to outvote. Only 2 investors are required to outvote. So if only 2 investors are required to outvote this particular investor, I think in this particular case, the power cannot be present. So moral of the story, If you just start looking at the examples, in the very first example, 48%, rest is widely dispersed, and your relative size is bigger, you get power. In the second example, if it would have been simply a case of 48% with other 12 investors, 5% each, in this particular case, we can say too many people to outvote me, subjective. But in this particular case, very less people to outvote me, just two people join hands and they can outvote me, I lose power. I cannot get power. The other two people are going to get power. At this stage, I would also like to clarify another thing as well, which can become a point of confusion at a later stage. So let me clarify. If I say that one investor has got a control, does this mean that no other investor can get a significant influence? No, I cannot conclude that. If one investor controls a company, there is a possibility that another investor can get a significant influence, but certainly no investors can get joint control. Because if one investor controls, then the possibility of other investors jointly controlling cannot arise. But another investor getting a significant influence can definitely arise. So let's also keep in mind, a control by one does not mean that no other investors cannot get a significant influence. They can. They can. Okay, let's take it further. So that was example number 6. Now let's have a look at example number 7. So let's have a look at example 7. So in example number 7, I am given the investor has got a 45% voting rights, less than majority. 11 other shareholders have got 5% each. That's it. Nothing else is given in the question. You would now easily understand this. I've got a 45% stake, and there are total 11 investors with 5% each. That makes it a total of 100%. So this is a case where we've got less than majority voting rights. We've got less than majority voting rights, and there is nothing else given. You can see in all these examples, he is concentrating on one constant data, less than majority voting rights. One was close to majority, 48. Another was a little away from majority, 40. And this one is also away from majority, that is 45. And in some cases, he added an element that you've got the right to appoint and remove KMP. Don't worry, I'm going to make a chart immediately after this. After the examples, I'm going to create a chart. So in this particular case, we can say that, do you think these 11 investors would outvote this one investor? I would not say a yes. I would not say a no. And that's what the conclusion they've given, that additional facts and circumstances may provide evidence investor has or does not have a power. So we cannot give any conclusion. I would say it is purely subjective in nature. It is purely subjective in nature. I think at this stage, before I go to the next example, I would like to add something to give you a clarity. Now, if you just have a look in terms of the analysis, I'd just like to make a walkthrough of the permutation combinations we've seen, and so that we get a little more clarity on the thoughts. So let me consider certain permutation combinations, and let us make some remarks whether a power is going to be there, or it is subjective, or it is not there. Now see the combinations working in. Number 1. The very first example which I did with you was a case that I had a 48% and rest of the investors were 1%, less than 1% each. So the very first example was concentrating that I am an investor which is the biggest investor in the company. I have less than majority, but still I'm the biggest investor. And if you look at the relative size, the relative size in this case is big. The relative size of this investor is big, and the relative size is big, then there is a possibility that power should arise. Logically, the power should be present. That was the first example. Then we went to the next example and we said we have got 40% and there are 12 investors with 5% each. Now here, your relative size is not big. Here, if you consider that your relative size, I would say it's not that big. It's not that big. In the previous one, it was quite big, but in this case, it is not that big. So when you compare yourself with the other investors, here you are too big as compared to others. Here you're not that big as compared to others. So you need to look into the possibility that can others outvote you? Can others outvote you? That is the key question which you need to evaluate. I'm teaching you how to take decisions. So in this particular case, you're looking at can other people outvote you? And in this case, more people who are required. In this particular case, they cannot outvote you. Less the people required to outvote you, they can outvote you. And 12 is a little larger number. So in this particular case, we can say it becomes subjective. It becomes subjective because in this particular case, we can say it is subjective. So more the people, it is difficult for me to prove that they will outvote you. So it is subjective. We can't say yes, we can't say no. It is subjective. Then we saw another example. I'm not adding that element of KMP. I'm not adding that element of KMP. That was a separate example. Then we looked at another example where I had a 40% stake and there were two investors, 40 or it was more than that, 45. We looked at another example where we had a 45% stake and there were two investors with 26% each. Here again, if you see, your relative size is not at all big. Not at all big. Can you see the chain of thought? In this case, your relative size was definitely bigger. It was not that big. Here I'm saying it is not at all big. Your relative size is not at all big. So you look at the same question. You look at the same question, can the other people outvote you? It is very easy that two people, less other people, they can easily outvote you. So in this case, we said, yes, there is no power with me. I have no power as a shareholder with less than majority because those two people can easily outvote. So you can see the chain of thought with which the inputs have been given. If your relative size is too big, it is a little easy for me to prove power. I am big, rest small. If your relative size is not that big, you need to see that those people can outvote you or not. More the people required to outvote, it is subjective to take a decision. Less of the people required to outvote, you lose power. Then we went ahead with another inputs in this particular case. So this was the case of the two investors. Then he gave you the example 7, where I've got a 45% stake. I've got a 45% stake. And in this particular example, we were looking at 11 people. We were again looking at 11 people with a 5% stake. This is, I would say, quite similar. This, I would say, is quite similar to the second example. Though in the second example, what they did along with this, they added the KMP element. Otherwise, it would have remained subjective. Just because of the KMP element, it became a confirmed case. Because the right to KMP could not have been snatched away. But otherwise, this case is as good as this. So we can say the relative size is not that big. The relative size is not that big. In this particular case, it's not that big. So what do you need to do? You need to do the same assessment that can these people outvote you? 11 people will be able to outvote me? Subjective. So in this particular case, again, we decided it is completely subjective in nature. So it is very important that you look at a comparison of these examples and create a thought process in your mind. So we can see the chain very clear that if your size is relatively bigger, there is a possibility you get a power. If your size is not as big as compared to other, or I mean, it's not really big as well, then the focus shifts in terms of if your size is not that big or not at all big, other people can outvote you. More the people required to outvote, you will get power. Less of the people required to outvote you, you lose power. I guess, friends, I am pretty clear with my input so far, right? I guess I'm pretty clear with this input, absolutely clear on the thought processes which is going on in terms of less than majority voting rights, right? So far, so good. Now, let's take it further. So let me now come back to the example number 8. So let's look at example 8. Now here there is again going to be a little twist. It says investor got 35% of the voting rights. Now that's less than majority, and that's quite less as compared to majority. That's quite less as compared to majority. 35% is again going down. Then he says there are 3 other shareholders which has got 5% each, and the remaining voting rights are held by numerous other shareholders, none of which has got more than 1% rights. So the pattern of investment is you've got 35%, and then there are 3 investors with 5%, and then the rest of the people is nothing, less than 1%. That's how the constitution takes place. Now here again, you can see that your size is relatively compared to others not that big. If you compare your size with the other 3 investors, 15, neither they are big nor you are big. And even if all of you join together, it still becomes 50. 35 plus 15 makes it 50. So it is completely subjective. Looking at the basic percentage of voting rights held, I think it is very difficult to make any kind of assessment. Now, it tells me further, decisions about relevant activities requires the approval of majority votes. 75% of the voting rights are required. Every time you need to take a decision, 75% of the people should agree. 75% of the people should agree in this particular case. Do you think there is any way I could achieve a 75% combination with a mere 35% holding? Is it possible for me to achieve that 75%? No way. So in this particular case, it's a clear-cut case. When you say you've got less than majority voting rights, it's a clear-cut case that power cannot exist. But let me also tell you, here one would also start evaluating, what is the voting pattern in the company? When the shareholder meeting takes place, how many people attend those meetings? That can also be relevant. And one of the questions which came in the RTP was focusing on that particular issue itself. So he adds on that there is an active participation of other shareholders at the recent meetings, which indicates that no one has practical ability to direct. So let me also add another point as well. Let me add another point. This illustration throws another lighting point as well. Let me just, add this point. If I were to create a thought process in my mind in terms of taking a decisions, it would go something like this. It would go something like this. I would say the possibility number 1 is that you've got less than majority. You've got less than majority, but we also consider that your relative size is big. Your relative size is big as compared to any other investor. So one possibility is you've got less than majority and your relative size is much bigger as compared to any other investor. The possibility is that the power will be present. The possibility is that the power will be present in this case, because if you are on your own, the biggest investor, everybody is too small in front of you, the possibility is you'll get a power. Now, the other one is that you've got less than majority voting rights. But in this particular case, you say that your relative size is not that big. Your relative size is not that big, or you can say that it is not even, comparable. So it's not that big. Then in this particular case, you start thinking. Then you start thinking in terms of that more people are required to outvote. More people are required to outvote you, or less people are required to outvote you. The focus changes in terms of less people are required to outvote you. So in this particular case, when you say that less people are required to outvote you, then I would say in this particular case, you'll definitely lose power. Because if you're less than majority and other people can easily, two people can just join, throw you out, then in this particular case, you lose power. But if more people are required to outvote you, in this particular case, again, the thought processes will change. So when more people are required to outvote you, in this particular case, again, we'll start looking at, and I would say in this particular case, you should start looking at the meeting participation. When the meeting takes place, are these people active or are these people not active in those meetings? That is also, another thing which one can evaluate. That when a meeting takes place, more people are required, but these people are active or just, sleeping people. If more people are required to output and they're very active indeed, then I would say in this case, the concept of power in this particular case would generally not be present. Because if they're too active in nature, they may throw you out. But if these people are not active, then I would say it can be subjective in nature. So this is a thought processes with the help of which one can take decisions in things. Let me also give you a console factor before your mind starts ranking wild. So this can be very subjective. In the exams, there has never been questions on assessment of control. But I think the journey in terms of Ind-AS 110 is incomplete if you don't understand the control aspect. You cannot become a chartered accountant, understanding only the procedural technique of understanding how consolidation is done. At the end of the day, when you end into a practical life scenario, you need to be clear in terms of taking decisions on the control assessment as well. So I've just given you your thought processes based on that. Okay. So this is one. Now let's take some more example. I am now coming to examples on potential voting rights. Another last two examples on this area where we're looking in terms of potential voting rights. Now, before I take the two examples on potential voting rights, let me give you another inputs as well. I know you must be thinking, consolidation has got so much of theoretical ideas as well. I can understand. But you would have realized so far that in terms of financial reporting, it is very different from the traditional accounting which you do at the intermediate and the foundation level. It is, at the foundation intermediate level, you've got, more exercise in terms of, making ledgers, journal entries, etc. That's like a very core kind of accounting. But this is more like, a decision-making kind of accounting. So it's more like, you've got a lot of areas which are, first of all, given to you as inputs to decide. It's more like income tax, more like law. You've got certain laws, you've got certain rules on the basis of which you need to consider your evaluations of the case study. I find it very interesting indeed. Okay, now before I take the concept of a potential voting rights, let me just add a basic input. When you're looking at the concept of potential voting rights, I would say I need to consider my potential rights. I should also consider other investors' potential voting rights. Because my potential voting rights might give me a power and other investors' potential voting rights might snatch away my power. If somebody has got potential voting rights, he's entered into a contract where he will buy shares from me, he can take away my majority. So in terms of potential voting rights, you need to consider the investor's potential voting right. You should also consider other investors' potential voting rights as well. Your potential voting rights can give you power. You need to make an assessment that right now you've got less than majority. And if you exercise them, it gives you power. Other people's potential voting rights can snatch the power. It can snatch the power out of you. So we need to look at both the sides. We need to see that my potential rights might convert me from a less than majority to majority. And the other investors' potential voting rights might convert me from a majority to less than majority. And I might lose power. So you need to look at both the sides of the coin. Now, let's have a look at example 9. A has got a 70% voting rights. You are a majority vote holder. Investor B has got a 30% voting rights as well as an option to acquire half of the investor's A voting rights. This is the potential voting rights of the other investor B. B is got potential voting rights where he can acquire 50% of A's share. That would mean 35%. Then A would be left with only 35. The option is exercisable for the next 2 years at a fixed price that is deeply out of money and is expected to remain so for the next 2 years. I think we have already known that when there is a potential voting rights, your first assessment is in terms of whether they will be exercised or not. In this case, it is very clearly given that it is deeply out of money, which means that investor B will not exercise these potential voting rights. If he is not going to exercise these potential voting rights, then in this particular case, A will retain a 70% stake. And if A will retain a 70% stake, undoubtedly he's got power because nobody is going to snatch. So in this particular case, we can say we're looking at other investors and A will continue to get power in this case because B is not going to exercise. And if he's not going to exercise, then the stake of A remains at majority. The power continues. Okay, that was great. Now let's have a look at example number 10. Last example on the power assessment. So let's have a look at example 10. This is potential voting rights in terms of the given investor itself. It says investor A and 2 other investors each has got 1/3 of the voting rights. So everybody's got 1/3 each, 33.33. The investee's business activity is closely related to A. So whatever is the investee's business, it is closely related to A. In addition to equity instruments, investor A also got debt instruments convertible into ordinary shares at any time, and that is out of money, but not deeply out of money. The status of the potential voting rights is that it is supposed to be, it says out of money, not deeply out of money. If it is out of money, it means it is subjective. It means it is subjective. I can't really conclude that whether I will exercise them or not. So let's see if more facts are given. If the debt is converted, A will get a 60%. So if the conversion takes place, he becomes a majority. Investor A would benefit from realizing synergies if the debt instruments are converted. The business of B is closely related to A. And he said that if the conversion takes place, A as an investor would get synergic benefits as well. If he's going to get synergic benefits in this particular case, then I think it seems an incentive that A will definitely exercise these options. Because if he is getting an incentive that he's going to get, a control number 1, and he's going to get synergic benefits number 2, this is pushing towards the fact that he would exercise. So A has got a power over the investee because voting rights together with substantive potential voting rights gives it the current ability to elect. So given the facts of the case, the subjectivity gets diluted and we will be able to conclude that yes, in this particular case, A has got all the incentives because of the potential synergic benefits that he would exercise. Wow. So I think the potential voting rights is done. You would have now seen in all the examples, we had cases of all those subjective cases, potential voting rights, right to appoint KMP, or nothing was there apart from that, all cases done. Okay, so this is the inputs which is done. Now, we're done with the step number 1. Now we need to go to the step number 2 and 3 and then consolidate the picture. The control assessment based on the voting right concept is done. Let me see if any questions coming in, though I don't think so. There might be questions coming in. Okay, that's wonderful indeed. Because I think in this particular case, we've given you a good inputs, but please do revise what we've done because this element may not be questioned in the exams, but then you never know, a possibility that small kind of questions could come, because now moving in the new course, 30% is going to be based on an MCQ. So conceptual understanding is a bit required. 30 marks is huge, because that 30 marks which you're going to get in the exams on MCQ, if you're going to be able to crack this, your paper is done. Okay, now let's go to the step number 2. So reminding you on the 3-step model, one was the concept of power. In terms of power, we've done 3 elements: existing rights, done; then current ability, done; relevant activities, done. Now comes the step number 2, that you are exposed, or you've got rights to variable returns. I am now going to give you a very interesting example. Please watch this carefully. It is one of the examples which is given in the standard itself. And you'll love this example for what I'm going to say. In the next few minutes, you'll love it. I'll just take a quick run through on 2 examples with you. Let's take a quick run through on 2 examples with you. I'm going to look at the concept of power, and I'm going to look at the concept of exposure, and then we're going to look at the step 3. So I'm going to look at the step number 1 also. I'm going to look at the step number 2 also. Simultaneously, I'm also going to explain the step number 3 in this example itself. So I'll be step number 3 of this step 2. Now watch this carefully. So we're looking at existing rights, current ability, and relevant activities. We're looking at exposure to variable returns, and we're looking at the concept that there is a linkage between the power as well as the concept of return. So let's take some cases with you. Watch this carefully. Let's take case number 1. Now look at the facts very carefully. I'm going to give you first a simple example and then a slightly complicated one to understand this bit. Let us say the investor he's got majority voting rights. The majority voting rights is on account of ordinary shares. The investor has got majority voting rights in the form of ordinary share. Is that an existing right? Yes. Unless mentioned otherwise, will it give it a current ability to direct the relevant activities? Yes. If there's nothing to the contrary, I can assume that being a majority voting right holder, unless mentioned otherwise, as we've seen earlier, it'll give you a current ability to direct relevant activities. Now, let me ask you, if you're holding ordinary shares, are you exposed to a fixed return or a variable return? Undoubtedly, we are getting a variable return. The returns which are given on ordinary share, equity share, is supposed to be a dividend which is never fixed in nature. It is a variable return. So as an investor, your ordinary share is giving you a variable return. Now, if your step number 1 is a yes, and if your answer to the step number 2 is yes, the linkage is a yes. If you say yes, yes, yes. If you say yes, no, no. If you say no, yes, no. So step number 3 doesn't need much evaluation. The moment you say in step 1, it is a yes, you say in step 2, it is a yes, the linkage is there. The power is there, the exposure is variable. So there is a linkage between the two. The step number 3 is done. Now let's look at another example. Let's take a second example with you. Let's say now the investor is got less than majority voting rights. He's got less than majority voting rights in the form of ordinary shares. And he's also got potential voting rights in the form of, let's say, convertible debentures. So let's say he's got 2 kinds of rights. One is less than majority voting rights with the help of ordinary shares, and he's got potential voting rights in the form of convertible debenture. Now let's see, are these existing rights? Yes. If I say that these convertible debentures are something which is deeply in money, If I say that it is something which is deeply in money, I would say yes, it'll give you a current ability to direct the relevant activities as well. Because if I'm going to consider that these potential voting rights, that is convertible debentures, are something which are bound to be exercised and they will be exercised before the date of meeting, we can say the current ability will come. So considering the current ability to direct relevant activities is present. Okay, now the question arises, on account of ordinary shares, you are exposed to variable returns. On account of convertible debentures, are you exposed to variable return or are you exposed to fixed return? Variable return. You're exposed to variable return, sir. Debentures don't give us a variable return. Debentures will give us a fixed interest. So why are you saying that the return on the debenture is variable? You need to watch out the wordings which is given. You are exposed to variable return. I'm not saying that you're entitled. There is a difference between the word entitled and exposed. I'll explain. If you are getting a fixed interest on a debenture, you're entitled to a fixed return. If you're getting, let's say, if you're making investment in a debenture, you are getting interest, you're entitled to a fixed interest, but you're still running a risk. You're running the credit risk, and that is the investee may not be in a position to give you that fixed return. You're running a credit risk of a failure on the part of the investee to pay that fixed return to you. Sir, that would make every kind of return variable in nature. Yes, the standard very clearly tells us as an example in the appendix that if a company is invested in debentures and it is getting a fixed interest, you are still exposed. You're still exposed to a variable return. The word is not that you're entitled. The word is exposed. It doesn't say that you're entitled to a fixed return. If you're investing in a debenture, you are entitled to a fixed return, but whether the company will be able to pay you the fixed return or not depends upon its ability to pay. And if there is a credit risk, then you are running a risk. You're running a risk in terms of exposure to fixed return. There is another interesting example which is given in the standard where it talks of that, let's say if you're a fund manager and you are managing the funds of a company and you're getting a fixed salary to manage the funds of the company. Are you exposed to variable returns? You are. Because even though you're getting a fixed salary, but still you are exposed to variable return because you're running a credit risk. The failure in terms of the company being able to pay your fixed salary. So that means, sir, if you're working on a fixed salaries, we're entitled to fixed salaries, yes, but we're exposed to variable returns, yes. Tomorrow your employer may not be able to give you a fixed salary. So we are article clerks, we're getting a fixed stipend. Do you mean to say that we're exposed to a variable return? Yes. You heard me correct. You're entitled to a fixed return, but you're exposed to a variable return. Tomorrow, what happens if your firm is as well? You're running a credit risk, the failure of non-payment as well. So the standard says that yes, you're getting a variable return. So in this particular case, the step number 1 is a yes. The step number 2 is a yes, and that would also develop the linkage. And I would say yes, the linkage is there. And once you're able to prove step 1 is yes, step 2 is yes, and the linkage is there, in all these cases, I would say the control is a yes. The control in this particular case is a yes. So this is the entire 3-step model in terms of making a control assessment. So I think a little quick revisions, just a few minutes, just a quick recap of the concept. So I have given you the inputs that when you're looking at a control assessment, you got to consider the step number 1 and see that do you get a power? And we've seen that in terms of power, you need to consider existing rights, which could be in terms of voting rights, or it could be in terms of appointment of KMP, Voting rights could be majority where you get a power or not a power, or it can be less than majority where you need to look at the permutation combinations. Look at the chain very clearly that in case of power, existing rights, we saw voting rights coupled with KMP. Majority may give you power, may not give you power. Less than majority depends upon the permutation combination. The second is the concept of current ability, which means when the need arises, where I give you a chart in terms of what kind of existing rights are there. We gave you the inputs in forwards, options, and what parameters need to be evaluated. And then I gave you the relevant activities, the list of all what is relevant, something which will be significantly affecting the returns of the investing. Then after the concept of power, you need to consider that there is an exposure. I think now you've got your inputs. What is exposure? It is not the amount which you're entitled to, which will be called as fixed or variable, but what you're exposed to. Somebody needs to pay me a fixed money, but I'm exposed to a credit risk of a non-payment. It makes you look at the concept of linkage. Linkage is nothing but once you're able to prove that the two steps is a yes, then the linkage gets developed and the control assessment takes place. Right, friends. So I think this gives us a good connect in terms of things. I hope I am very, very crystal clear on the concept of the control assessment. Okay, let me see if any questions coming at this stage, friends. Okay, so I think nothing coming so far. So I think before we end, I must remember again, friends, to wish you and your family a very happy, prosperous New Year 24. Hope this new year brings in a lot of opportunities to you, and looking forward that you all become qualified chartered accountants as well. And trust me, with your hard efforts, with your parents' blessings and your mentors' blessings and all, of course, everything is going to be possible as well. So I once again take the opportunity and wish you a very, very happy new year to all of you. If you got any questions, friends, ask me. Otherwise, I think we are done for the day. And now we're going to meet you on the new year, that is on 2nd of January. We're going to continue with this particular standard. So 2nd January, we continue with India's Sun in 10. Okay, I think Nivetul, you said, so what if any of these steps fails? Well, if any of these steps fail, the control is not there. Because you need to prove a yes to step 1, a yes to step 2. If any of the step 1 or 2 fails, step 3 will be a no. And if step 3 is a no, the control is not there. Control will be present only if you get a yes on step 1, 2, automatically step 3 would also be a yes. Okay, I guess Manoj, so happy new year to your families and friends. Thank you, Manoj. Thank you indeed for the good wishes. Okay, I guess Nivitul, you got your answer on that, I guess. Right, friends. So I think that seems to be all good. No further questions coming in. Right, friends. So thank you, all of you, once again. And see you in the next year. See you in the next year on the new year. Bye-bye. Take care. Thank you very much indeed. Thank you, Suraj. Thank you, Nivetal. Thank you, all of you, once again. Bye-bye and take care. Class is over.